In Chapter 2, we examined the three principal financial statements and reviewed the income statement, the balance sheet, and the statement of cash flows. In this chapter, we're going to use those basic financial statements to conduct some ratio analysis. And this chapter is titled Financial Analysis, but we're going to start that investigation or that discussion using ratio analysis. Now, ratios are around in our day-to-day activities, many examples. If you purchase an automobile, you look at the sticker on the automobile. The sticker will report the expected miles per gallon, the fuel efficiency rating. Miles per gallon is a ratio. Ratios are very useful because they allow us to scale. Let's take an example. If a firm made $1 million, is that a good year or a bad year? Well, $1 million in profit for a single store, locally owned company might be an excellent year. But $1 million in profit for the year for Walmart would be rather disastrous. Walmart makes billions of dollars, not millions. So what's the difference between $1 million being an acceptable level of profit and being a poor level of profit? Well, in that case, it's essentially the size of the enterprise. Walmart's a much bigger organization. It expects to make higher profits. But $1 million by itself, that absolute number, doesn't tell us very much. So we turn to ratios. Ratios are used to weigh and evaluate the operating performance of firms. And we can use them to compare performance against firms in the same industry. So, for example, we might compare Walmart to Macy's. And in fact, we'll see an example of that later on. There's a lot of data available from various organizations on industry averages for ratios. So if we are able to calculate ratios for an individual firm, we can then compare that firm to an industry average to gain some insights on what the firm does better than its peers and what it doesn't do as well as its peers at. Another area that ratios are useful is in something we'll refer to as trend analysis. Ratios are not only useful for comparing one firm against another, they're useful for comparing a firm against itself at some other point in time. Let's go back and consider Walmart for a moment. If Walmart makes more money this year, earns a bigger profit this year than it did 5 years ago, well, that shouldn't be very surprising. Walmart was a smaller firm 5 years ago than it is today. So when we ask, how is Walmart performing, in an operational sense, how is Walmart performing, we need to be able to measure income against some metric of firm size. And that allows us to compare the same firm across time. So ratios really serve two purposes. They allow us to compare a firm to other firms at one point in time, or they allow us to compare a firm against itself through time. We're going to start our discussion of ratio analysis by classifying or segregating the various ratios we're going to be interested in into four different types. We're going to look at 13 different ratios. Now, these are not the only ratios that an analyst might consider calculating, but they're some of the more common ratios that financial analysts use. So the first set of ratios that we're going to be interested in are referred to as the profitability ratios: profit margin, return on assets, return on equity. An investor might be particularly interested in these ratios. They're likely to be particularly interested in the profits that the firm is earning. Asset utilization ratios consider how effectively the firm is utilizing its assets. So how quickly receivables are being collected, so receivable turnover, the average collection period, which is another way of looking at the same issue, inventory turnover, how rapidly inventories are being moved through the system, fixed asset turnover, and total asset turnover. Liquidity ratios examine how capable a firm is of meeting its current obligations. A creditor, a trade creditor, might be particularly interested in this. Before offering credit to a firm, which would be an accounts payable to the firm that receives the credit, before a vendor offers credit to a firm, they want to have some feel for whether or not they're going to have difficulty in collecting. So they want to know how liquid the firm is. So they would consider a liquidity ratio, current ratio, and quick ratio, which we'll talk about in more detail. Finally, debt utilization ratios. The debt to total assets of the firm times interest earned, and what a term or a ratio we refer to as the fixed charge coverage. Now, a bondholder or a bank lender might be particularly interested in the level of debt that the firm has, as well as, in times interest earned, their capacity for earning enough money to pay off that debt as it comes due. So the various analysts may focus on different ratios. At this point, we're interested in just examining ratios more generally. So for a quick review of those ratios, the profitability ratios are a measurement of the firm's ability to earn an adequate return on sales, on assets, and on invested capital. The asset utilization ratios measure the speed at which the firm is turning over accounts receivable. Liquidity ratios emphasize the firm's ability to pay off short-term obligations as they come due. And the debt utilization ratios estimate the overall debt position of the firm and evaluate that position in light of the asset base and earning power of the firm. For the ratio analysis that follows, we're going to make reference to the Saxton Company's income statement and balance sheet. The ratios that we calculate will all be pulled from this company's financial statements.